Bitcoin could climb to $200,000 and Ethereum could surge to $12,000. That's the forecast from Fundstrat's Tom Lee, one of Wall Street's longest-running crypto bulls. But what's different this time is how he believes it will happen. Lee believes the 2026 bull run isn't following the usual 4-year cycle. Instead, it's being shaped by three forces that most investors aren't paying attention to. The Federal Reserve is preparing to cut rates, inflation is easing faster than expected, and AI-driven capital is flowing back into tech and digital assets. Together, these shifts could ignite a powerful move across the entire crypto market. Bitcoin remains one of the most underowned assets in institutional portfolios, while Ethereum continues to attract demand through tokenization and smart contracts. According to Lee, the setup heading into next year may be stronger than anything the market has seen before. In this video, we're breaking down Tom Lee's new 2026 prediction, what's fueling his Bitcoin and Ethereum targets, and why he believes the coming cycle could mark the beginning of a very different market phase. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's break down exactly how Tom Lee believes this setup will unfold and why it could send Bitcoin and Ethereum into their next major rally.
I think in the final months, I think one surprise is the AI trade's going to come back strong because it's wobbled. But the Fed is getting people scared because is the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
Tom Lee believes the most powerful trigger for the next market rally is already in motion. Inflation data has been softening across major economies, giving the Federal Reserve room to pause and eventually begin cutting rates. The moment that easing cycle is confirmed, liquidity begins to return, first to equities, then to high-growth sectors like technology, and finally to digital assets. According to Lee, if the Federal Reserve cuts in December, it would send a direct signal to markets that the tightening phase is over. Historically, the start of a rate cut cycle has coincided with some of Bitcoin's strongest periods of growth as cheaper capital floods back into speculative and innovative assets. What makes this cycle unique is the return of the artificial intelligence trade. After months of volatility, AI-related stocks are showing signs of renewed strength. Nvidia, which recently reported quarterly earnings exceeding expectations by more than 30%, has once again become a proxy for risk appetite in technology. When AI leadership expands, capital tends to rotate toward other high beta markets, and crypto often benefits first. Lee points out that financials, small cap stocks, and tech all move in tandem with digital assets, forming a broader risk-on ecosystem that thrives when policy loosens. Market data supports this. The correlation between Bitcoin and the Nasdaq 100 has tightened in recent weeks, while institutional flows into ETFs continue to rise. A December rate cut would reinforce investor confidence and signal the start of a global liquidity rebound, giving crypto a tailwind heading into 2025. Lee's view is simple. Once the market accepts that inflation is falling and easing has begun, crypto could stage one of its strongest rallies yet. Next up, we focus on why Lee thinks Bitcoin and Ethereum have the most upside in this setup.
I think people have dampened their expectations for Bitcoin partly because Bitcoin's been treading water, and there have been a lot of OGs, original Bitcoiners that are selling above 100,000, but it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year. I think it's a big ask, but to me, what's more obvious is Ethereum can have a huge move into year end, because even Cathie Wood wrote about it. She thinks stable coins have been cannibalizing demand for Bitcoin, and gold and tokenized gold is cannibalizing demand for Bitcoin. But stable coins and tokenized gold run on smart contract blockchains like Ethereum, and Wall Street is building, and Larry Fink wants to tokenize everything on the blockchain. That means Ethereum is where people are starting to raise their growth expectations. And if you're raising your growth expectations, then your discount to the future is going up. So I think that there's a bigger move in Ethereum. And Mark Newton, our head of technical strategy, thinks we can be like 9 to 12,000 by January. I think that's about right. I think Ethereum just 3,600 more than doubles between now and year end, or between now and January.
Tom Lee says Bitcoin remains one of the most underowned assets in the world. Despite spot ETF approvals and growing institutional participation, most portfolios still hold little to no exposure. That underallocation creates powerful upside potential once liquidity returns. Lee expects Bitcoin could rise toward $200,000 by the end of the year, driven by fresh demand from asset managers and corporate treasuries now permitted to buy through regulated products. The supply side continues to tighten, with over 70% of Bitcoin's total supply inactive for more than a year, a signal that long-term holders are refusing to sell. But it's Ethereum that Lee believes has the clearest runway. Tokenization, smart contracts, and stablecoins all rely on Ethereum's network. BlackRock's Larry Fink has repeatedly emphasized that everything will be tokenized, and the infrastructure being built to support that vision, on-chain treasuries, bond settlements, and real-world asset protocols, largely operates on Ethereum. With that kind of institutional momentum, Lee and Fundstrat's head of technical strategy, Mark Newton, see Ethereum climbing from around $3,600 to as high as $9,000 to $12,000 by January. Additional data backs this outlook. Layer 2 scaling continues to expand transaction capacity while burning Ethereum through fees, reinforcing its deflationary model. Stablecoins issued on Ethereum have surpassed $160 billion in value, strengthening its base demand. When combined with the easing cycle Lee outlined earlier, these factors form a setup for both assets to outperform nearly every other market. Next, we look at why Lee believes the cycle stretching into 2026 may remain bullish despite what most analysts expect. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
This is really the reason 2026 is probably not as bearish as people think, because now next year, I think people are going to be like, wow, wait, NVIDIA and all these are public companies, and their earnings are growing 50%. I think people are going to actually start chasing them next year. That's really positive for crypto because, as you know, there is also this argument today that the crypto cycle is a 4-year cycle, so it should be ending now. So
Yep.
people are trying to fade that. I think people are trying to fade everything, the S&P and the crypto, but forgetting that the Fed is beginning to cut, and the ISM, and we've written about this, is more correlated to Bitcoin than monetary policy. And until the ISM gets to 60, Bitcoin really can't peak. So I think this is pretty positive for crypto. But crypto, it's kind of been hurt because, monetary liquidity hasn't been really increasing. The Fed has been under QT, quantitative tightening.
Yep.
That's ending in December. And the Fed hasn't really given clear signals that they want to ease. So I think there's been a little bit of confusion for investors.
Tom Lee argues that 2026 will not be the bear year many expect. The usual 4-year Bitcoin cycle, where markets peak after each halving, is being disrupted by larger macro shifts. He points out that earnings growth from public companies like NVIDIA is accelerating at a rate of nearly 50%, drawing investors back into growth assets. As confidence in tech rebounds, risk appetite naturally extends to crypto. Lee believes next year's rally could catch most traders off guard because they are still anchored to old cycle patterns. A key part of his reasoning comes from the ISM Manufacturing Index. Fundstrat's research shows that Bitcoin's price correlates more closely with the ISM than with monetary policy itself. When ISM readings climb towards 60, Bitcoin typically reaches local highs. The current ISM sits below 50, indicating contraction. That suggests Bitcoin has room to run before topping out. At the same time, quantitative tightening, the process that has drained liquidity from the system, is ending in December, with the Federal Reserve preparing to slow balance sheet reduction and potentially start cutting rates. The liquidity backdrop heading into 2025 looks dramatically better than it did a year ago. Lee also notes that investor confusion has held markets back. Some fear that easing too soon could reignite inflation, while others doubt crypto's correlation to broader economic data. But as those concerns fade and corporate earnings keep surprising to the upside, money will start chasing performance. The more capital returns to equities, the more likely it is to spill over into digital assets. Lee believes that by mid-2026, this interplay of rising ISM data, renewed liquidity, and revived tech momentum could extend the crypto expansion rather than end it. Next, we examine Lee's take on inflation fears and why he believes they are misplaced.
I think the most overrated risk is that inflation's coming back.
I thought you were going to say that.
I mean, I know, huh?
I thought you were going to say that. I had a bet on that.
Okay, well, maybe that was a polymarket bet. But the reason I think it's overrated is I think too many people think monetary easing cycles create inflation, or they think GDP growth creates inflation. But inflation is a very mysterious thing because we had a lot of easy money for years and there was no inflation. And now that the labor market's softening and the tariffs basically were supposed to create another wave of inflation, it hasn't, and housing is now tanking. How do we get inflation if the big drivers are housing? The big drivers of inflation are housing, labor costs, and then goods, but none of those are inflating. I heard a Fed speaker last week say core services is inflating again. We checked it. That's dead wrong. PCE core services is now running at 3.2%. It's been long-term 3.6. It's actually running below average. And core services generally runs above 2% because goods offsets that. So I think that there's a false belief inflation is actually strengthening.
Tom Lee believes the market is still haunted by inflation that no longer exists. For nearly 2 years, investors have expected another wave of price spikes, yet the data has consistently shown the opposite. Core services inflation, which includes housing and labor, is cooling faster than many realize. The Federal Reserve's preferred metric, the PCE Core Services Index, has slipped to around 3.2%, below its long-term average of 3.6%. Housing costs, a major inflation driver, are rolling over as rental growth slows and mortgage rates remain high. Labor market pressure is also easing, with wage growth declining across most sectors. Lee argues that if the major inputs to inflation are weakening, housing, wages, and goods, then fears of a renewed surge are misplaced. Even the impact of tariffs, often cited as an inflation catalyst, has failed to materialize. This disconnect between perception and reality keeps many investors on the sidelines. They expect tightening, but the data supports easing. When that recognition spreads, sentiment will shift sharply, releasing the capital that's been sitting in cash or short-term treasuries. Historically, the most powerful market rallies begin when investors abandon outdated narratives. The belief that easy money automatically creates inflation was disproven in the decade after 2008, when central banks expanded balance sheets without igniting runaway prices. Lee points to that same dynamic today. Liquidity can rise without breaking the economy. If inflation remains contained while the Federal Reserve cuts rates, crypto stands to benefit from both improving fundamentals and renewed liquidity. The next step is to understand how these misconceptions about inflation, recession, and even market behavior kept most investors from recognizing this turning point.
The last 2 years and this year have showed the mass delusions can persist for a long time. And I'm sorry, that's not the right word, mass misconceptions. Because as we started this conversation, the reason people were bearish for the last few years is they thought that we were having a recession. They couldn't explain it because they didn't see it in the companies, but they were so sure because of the yield curve. And by the way, that made companies cautious, right? So companies forced themselves to change. And then people were convinced inflation was going to explode and just never go away. That is a massive disconnect from the actual underlying data. Because if there was massive inflation, companies couldn't even make money, and they were doing fine. I remember people said banks would go bankrupt because of the curve was inverted. Banks made a lot of money. So there is, I think, still this reflection that human behavior doesn't change. I mean, people believe something and they get anchored to it. And then most of the time when the data disagrees with them, people choose to believe themselves than to actually believe the data. I think the reason Fundstrat actually stayed bullish was that we weren't anchored to our view. We were anchored to the earnings, and the earnings came through.
Tom Lee says the last 2 years have been a masterclass in how wrong the crowd can be. Many investors spent the entire period expecting a deep recession, guided by signals like the inverted yield curve, yet the economy never collapsed. Corporate earnings held up, unemployment stayed low, and banks, supposedly doomed by rising rates, continued to post profits. Those same investors also believed inflation would spiral out of control, but it quietly declined quarter after quarter. The result was one of the most misunderstood markets in modern history, where fear overruled data. Lee describes this as a form of anchoring bias. Once people commit to a bearish outlook, they often ignore new evidence that contradicts it. Instead of adapting, they double down. Fundstrat's team avoided that trap by focusing on earnings, which kept improving despite the noise. By trusting the numbers instead of narratives, they stayed bullish while others waited for a crash that never came. This difference in mindset, Lee believes, is what separates successful investors from those trapped by outdated frameworks. He also warns that the same psychological bias may be holding investors back from recognizing what is happening in crypto right now. The fear of another crash or a delayed recovery is keeping many sidelined, just as institutions are quietly increasing exposure through ETFs and on-chain investments. As liquidity expands and inflation continues to fade, these hesitations could turn into a rush of late entries chasing performance. Markets reward those who respond to change, not those who resist it. Lee's takeaway is clear. The next phase of this cycle belongs to those who can see beyond the noise, trust the data, and position. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.